Welcome once again to Mid-State Money Talk. Joining us on the desk today is Al and Joe, both Dietrichs, both here in the family, both part of First Choice Financial Services. I'm your host, Spike Spangle. Al, what would you like to talk about this week? What's concerning you?
Well, let's talk about taxes, some of the top retirement risks that appear.
Oh, sure.
And we can also talk about some of the concerns that we face from retirees when they come in.
Yeah, some other top concerns that retirees or pre-retirees that maybe don't fit into the big topics that we talk about.
All right, fantastic. So don't go anywhere. During our 30-minute program, we're going to try to not only discuss some of the things that might be on your mind, but solutions. What exactly do we do? What can the team help you do? When you see that phone number come up on the bottom of the screen, you can actually schedule an appointment. We'll explain exactly what a comprehensive portfolio review means to you. But a huge topic, and it just keeps coming up, Al, is taxes, how to get efficient with them. There's so many ins and outs.
Yes, there are. And, a lot of times when people come in, they're in a reactive mentality. We promote a proactive mentality. By that I mean, do you want to just gather your retirement things and put them in a box and take them to someone to do them and then find out what the results are? Or would you rather know going into tax season, options that you can choose from to where you can make some decisions that can have a positive impact on your portfolio?
Right. The active, passive, I think most folks, most Americans, most people watching the program, if they go to a CPA, if they use somebody, they probably go in, Joe, and say, I want to pay as little in taxes this year as possible.
It's reasonable, right?
Right?
Yeah. And that's key this year, right? So most of the time we are reactive most of our life. We talk about that and we think about it. We're kind of looking in the rearview mirror. We're now looking at, okay, well, what did I make this year? What do I have to pay or what do I get back? That's reactive, looking in the rearview mirror. What we would like to do, especially when we're going into retirement, because we have way more control in retirement on our taxes than at any time in our life. Now we're looking through the windshield. Now we're planning. We are preparing exactly, to the extent that we can, what taxes we're going to pay by where we're getting our income, that's where our accounts are positioned, that sort of thing.
Right. It's been a mentality that we've been kind of using for the last probably maybe 4.5 decades. Since you've talked about before, since 1978, when we started saving tax deferred into these retirement accounts. And we didn't know any better. But the carrot and the stick was, look, taxes are really high here in the late 70s, early 80s, right? Tax brackets were almost 50, 60%.
Right.
But if you put money away in this retirement account, you can take that off your taxes this year. Al, what has that done, though, to folks over 30 or 40 years? What has that done to those accounts?
Well, the accounts have grown. In fact, today, most people that we see, the bulk of their savings is in their 401k, 403b. Little savings outside of that, And so what occurs is now all of a sudden that short tax rebate or advantage we had turns into a big problem. In our office, we say, do you want to pay the tax on the seed or do you want to pay it on the harvest? Well, if you have a 401k, typically you're going to be paying on the harvest. You get a tax break on the 600 that you put in way back when, whether 6,000 or 7,000 today. But what does that grow to? And then you don't have a choice whether to take it out. You must take it out at a certain time, and we'll talk about that later. But it can be real devastating to your tax return and to your income.
Right. Joe, a perspective on these retirement accounts. It's a great thing. On another program you talked about a couple, they had saved $1.6 million. They were getting ready for their retirement. But was that all in tax-deferred accounts? Meaning, do they actually have $1.6 million if it's all in a tax-deferred account?
That's a great question. And I just mentioned where your assets are positioned. That's important. You don't really think about it. We've made this agreement with the government. We're saying, okay, we're going to defer those taxes and we're going to lower our taxes this year. But we've made a decision to really invest in the qualified accounts. And so, if you're in a 24% tax bracket and you've got $1 million, sorry, but you don't have $1 million. You have maybe $750,000. That's significant. There's money sitting in there that's growing that's really not yours. And we're not considering that when we're thinking about when we have to start drawing that out. Now, That's 24% today. That's what we know to be one of the tax brackets. You might be in 22, 24. We don't know what those tax brackets are going to be after 2025.
Right.
So now, maybe it's not 25% that you've lost. Maybe it's more than that.
Right. And if you don't mind, just for our viewers out there, they might not be as in tune with the tax. Why could they change it 2025? What's happening with the tax brackets?
Yeah, so we are currently now under a tax law. This is set in stone as to what our tax brackets are going to be. Now, there's some minor adjustments from year to year, but overall, this is set until the end of 2025. At the end of 2025, the current tax law is going to sunset. It's either going to revert back to where it was or something is going to replace it. And so, again, this is where we're talking about known versus unknown. We can make decisions 2024, 2025 on known entities, but then we're projecting what's going to happen in the future when we're making decisions.
Al, you've talked about this as legislative risk.
Yes.
We know about market risk. Most of our viewers are smart enough to realize the ups and downs. But legislative risk, it's like erasing the rules while you're playing a game. They can just change the brackets on us?
Yeah, that's exactly right. Yeah, that's how my mother used to play cards with me. She'd change the rules right at the end, but it happens all the time, and, we look at all these political things that are going on today, and at any time, any given party can go in there and make a decision, and that's out of our control. We can't control that. But what we can do is, while the current tax situation is what it is, let's maximize the advantages that it gives to you. And so you have between now and the end of 2025 to sit down with someone who can maximize that conversion for you that we're going to talk about, that can maximize that so that in the future, from here on out, all of that money that you now are converting over, it's going to grow tax-free. Well, tax-free is tax-free. Zero is still zero, right?
Yeah, that sounds great. In fact, you said after the break that you wanted to introduce me to this person called Roth.
Yes.
I'd like to meet them after the break, if you don't mind. Folks, call the phone number. Call it right now. What exactly is a Roth conversion? We're going to explain that in just a moment. But how can you get yourself to a tax-free lane in retirement? Maybe at least one tax-free income stream in retirement. It can be so vital when it comes to maximizing your Social Security, affecting or not affecting your RMDs, your required minimum distributions. A Roth conversion, why it can be one of the most important things you could do for your retirement in a moment. But call that phone number right now. Let's get you started on your complete portfolio review. More Mid-State Money Talk right after this.
When we tell someone something, they'll say, we can take that to the bank. If we can't do something, we'll tell them that. We're straight up with our clients. It all comes down to using the products for the people's needs, not selling product.
Being independent means that we have freedom to do what's best for our clients. We're not beholden to any other party to make sure that we're meeting a quota or restricted on what it is that we can do or provide. We're free to go out into the market and find what's best for them and what's going to meet their needs.
The world's our oyster, as far as what resources we have for our clients, and that's beneficial for our clients more than anything.
Don't be afraid to go ask for help. Find somebody you can trust and start the process. Obviously, the financial part is very important. Having a plan in place that's going to provide you with sustainable income, that's resilient to the changes of life and of the market, that's really important.
Money doesn't care who it serves. And one of the things that we like to do in our company is we like to be able to help people determine where their money is going to be and who it's going to serve generation after generation.
Welcome back to Mid-State Money Talk. On the desk today is Al and Joe Dietrich, our First Choice Financial advisors today, and we're trying to go through some of the ins and outs of how to get you most efficient with your retirement spend, your retirement savings, and it's always taxes. It seems to always come back to the taxes.
Yes.
As I told our viewers, the Roth conversion, we were going to explain a little bit about what exactly it is and how to do it.
Okay. He prefers to be called Mr. Roth.
Yes,
Mr.
it was
Roth.
Yeah, I was like, who's this Roth person? I don't get it.
Well, a Roth contract, it's an IRA, and it can be in or out of your 401k. It can be privately owned. And what they did is they came out with this contract. It's a tax rule, really, that says that you pay your taxes on the money before you put it in. So you're paying taxes up front. Meanwhile, while it's in this Roth contract, it's growing, and it's growing income tax free. So all of the money that you would normally leave in your 401k, that would grow as well, but also the growth on that is going to be taxable for you at some point in the future. By converting or opening a Roth, the dollars that are inside that contract will continue to grow tax-free, which I can tell you many, many reasons, but there's lots of reasons for you to have a Roth account so that down the road, when you need to take a trip or you want to buy another car, would you rather take the money out of a Roth account and pay no taxes on it, or would you rather take it out of an IRA account and I have to add that into the price of the vehicle or the trip?
Right, Al, and that's a good point, and I do want, especially I want to get to an example on it. But for a lot of folks out there, like you said, we've been saving tax deferred for decades.
Yes.
So we've got these accounts. If you have the opportunity for a Roth 401k at your workplace, it's definitely worth looking into. Maybe even if it's only for 2 or 3 years, you could be in your 60s, you could put a lot of money away in that. That could at least be one tax-free bucket. But the converting, I mean, there's a lot of folks, what do you say, $500,000, $1 million in tax-deferred accounts.
Yeah.
Do we convert all of that?
Well, maybe. the age-old question, maybe. So yeah, the conversion account, the Roth conversion is moving qualified money into the Roth. Now we're going to pay taxes on that money comes out. There is why the maybe is, because when we pull that out, it's going to be taxable. There is a prudent way to do that year over year, to have a strategy, a Roth conversion strategy that is a long-term strategy to convert Roth at the lowest tax rate or the tax rate that makes sense for you or for a particular client. Not a wholesale sell-off, right? We want to be strategic with it. You could really get ourselves in trouble.
Okay, so let's say I've got a $500,000 account.
Yep.
It'd be nice to turn it into tax-free money, but you do, the paying part is paying the taxes in it this year. If I did that all in 1 year, that becomes income. I jump up a whole bunch of brackets. So you're saying we could do this over a period of time?
Correct. So part of our overall planning process is we're going to look at that Roth conversion strategy and where it fits into the tax brackets that make sense. What are you paying taxes now? What do you expect to pay taxes 5, 10 years from now? Now, there may still be some unknowns there, but we can make some educated guesses as to what they might be, at least stress test it. So, for example, a couple came in and they're blessed. They've got $2.5 million, and almost all of it is in 401ks, IRAs. All right. Now, these are two high-wage earners, and they're going to retire very close together. So that means that they're going to go from high income to no income, and then be forced to take income again, all from qualified funds. So they're going from high income, known, to high income again, and at an unknown tax bracket, right? So when we put together their dynamic income plan, it was to layer certain pieces and include a Roth conversion plan so that we can start moving that out, especially during those years where they don't have any other income. That's a sweet spot during your retirement years.
Yeah.
Systematically.
Yeah.
absolutely.
Al, when you start to talk about this with folks, Roth conversion, pay taxes now. I discussed with both of your sons here before about how most people go and they're not proactive about taxes. They go to their accountant and say, I want to pay as little in taxes this year as possible. And then all of a sudden, a couple sitting across from you and you're saying, we want to pay more taxes this year. That's got to be hard to get across to somebody. Is that contrary to what they normally feel?
Yeah, it is. It reminds me of the story where my wife was putting a roast in a pan and she kept cutting off the leg, And I said, why do you cut off the leg? And she says, well, my mother did. And I said, well, your mother did. So I talked to the mother and she says, well, my mother did. So I talked to the grandmother and she said, because my pan was too small. People get in the habit of doing things, And so, you keep putting the money in. So now this is something different, completely different. And so, you need to make a mental adjustment to it. But when you look at the numbers down the road, that's the proof of the pudding. So when that person's across the table and I say, look, you're in a 22% tax bracket, you have to earn up to X amount of dollars till you get to the 24. How much of that do you want to utilize for a Roth conversion? And And then when we start looking at this opportunity may expire in 25, they get real aggressive with it.
Yeah.
They really want it. And like Joe said, you need to do it systematically. So you're not throwing them up into a 34, 37% tax bracket.
Okay.
Yeah, it has to make sense for them because down the road, maybe they're not going to be there. They're going to be at a lower tax bracket. So it has to be right for the client. But it's the systematic and the forecasting, when we cash flow that out year over year over year, that's where that apprehensive of this year's taxes have to be the lowest ever, go, oh, you know what, I can take that hit because I know it's going to benefit me down the road.
Well, that's exactly what I was just about to ask you. I'd like to know some of the benefits. People already, they're hearing the pain. They're like, why would I want to pay $30,000, $40,000, $50,000 in taxes this year? What are the benefits? I understand it benefits Social Security. I understand it can benefit your required minimum distributions. How so, fellas?
Yep.
Yes, well, let's talk about the Social Security angle, okay? There's a rule that determines what you're paying on Part B benefits, okay? It's called IRMA. And the more you earn in retirement, the more IRMA can come into play. In other words, if your income is between, let's say up to $125,000 at this point, we're just using that as an example, you're going to pay about $175 a month for your Part B benefit. But when you go over that, you may have to go up to paying $230, $240, $250 a month for the same exact benefit. So why would you want to, take a lot of it and do it at one time, and now you're really spending a lot of money? The other option is RMDs. At a time in your life when you're in your early to mid 70s, you have to start taking out your RMDs. It's going to increase your taxable income, which can affect your taxes on Social Security, your IRMA contributions. So if we can get that under control, get that reduced, now all of a sudden it's less likely that you're going to be facing a tax adjustment or a raise in the tax brackets, and you can have a more smooth retirement in the years of your 70s, not needing to go into higher tax brackets.
Right.
Yeah,
Joe,
so you're getting obviously a lot of consistency or some flexibility with that income plan. But the Roth account itself, like we said, we're talking about seed and harvest. So now we've paid it on the seed. The harvest is completely tax-free. What we've put in is obviously already paid taxes. The growth is tax-free. When we take it out, it's tax-free. And guess what? If we pass away and it goes to our heirs, tax-free. So there's multiple benefits of having that account there, especially not only for our own income plan in the future, but also our estate planning as to how we effectively transition those assets to our loved ones.
right. And are you finding that you're one of the fewer firms that's actually talking to folks about this? Is this consistently being talked about across the board when folks come in? Do they say, I didn't hear this from my financial group. No, nobody even told me about a Roth conversion.
Yeah, when it comes to communication, that's big. It's always looking forward, always looking forward. This isn't a one-time set it and forget it cookie cutter approach. We created relationships, and we're going to meet year over year and be looking at this. The Roth account is getting a lot more publicity recently, but it requires intentionality to sit down and say, let's put a plan together to do it. And not too many people are doing that.
Right. It's a great idea. It's a great tool. It's a great thing to think about to get a tax-free income stream. But as Al was also saying, let's make sure we don't maybe do it all at once and affect things like your Medicare costs, what your other tax brackets are going to be for that year. Talk with a professional. If you don't have somebody in your corner who you can talk to about doing something like a Roth conversion to get to tax-free income streams, you can call the phone number down there. Not only will we talk to you about your tax situation, but all of your retirement concerns, the investments, how much risk you're taking, estate planning, even your medical choices, long-term care, Social Security, how and when to take that, all of that as part of a comprehensive plan. And you can get started on that very simply by calling the phone number right now. We have folks standing by at our secure call center who will schedule that appointment for you. More Mid-State Money Talk right after this.
First Choice Financial Services, we're based out of Camp Hill, Pennsylvania. So if you're familiar with Harrisburg, there's a river that splits the Mid-State in half. And on the right side is the Harrisburg City, and on the left side is what we call the West Shore. We're based in Camp Hill, Pennsylvania, which is just across the river from Harrisburg.
Everybody that works in our firm just has a heart for other people. My 2 sons are partners in the corporation. Their wives are very active in the corporation. The rest of the people in the corporation are, all but 2, are family.
I wouldn't want a practice that's not family-based or faith-based. If you're a believer, you're a Christian, then you have to live that. It's your life. It's who you are. It's your identity. My identity is in Christ and Christ alone, and I'm not going to waver from that. And why not have that spill over into my business, my practice? It's all over our walls, all over our TV screens, and they can see our heart, and they know, hey, we take care of them, and we love them as individuals, and we care for them and their soul.
When we've sat down with somebody and we've taken time to get to know them and put something into place that's going to really meet their needs, to see the look of relief or the posture change when they walk out of the office feeling confident and a little less worried of the years to come.
Welcome back to Mid-State Money Talk. On the desk is Al and Joe Dietrich of First Choice Financial Services. Today we've been talking about, I know the Roth conversion can be a lot, but I also want to include some of the other risks in retirement. In fact, I'll start with you, Joe.
Yeah.
The risks in retirement, it's not just about the portfolio, you said. What do you mean?
Absolutely not. That's the one that we think of, obviously, top of mind. It's the low-hanging fruit, so to speak. But we have a lot of other risks. Inflationary risk is big. We think about inflation, but do we think about inflationary risks when it comes to our investments? Things that are overly conservative, are they keeping up with inflation? Longevity risk, are healthcare costs going up? Or the idea that we're going to need more healthcare as we get older. So there's a lot of different risks that can be in addition to that market risk.
Yeah, longevity, obviously you're seeing that a lot more. When you started all the way back in the late 70s, our lifespans are much, much longer right now. What's a minimum, especially since this is such a risk today, outliving our money and the worry of it? How long do you take your retirement plans out to? What do you guys do together as a family?
Well, we talk to the folks about, what their thoughts are on that, but we like to go at least 30 years because, there are retirees that live 30 years, especially when they're retiring at 60. 55, 59, 60. And so we like to look at a 30-year window. I'd much rather plan for more years and they pass on, not that I want them to pass on, but if they pass on early, that we're prepared for it. But it's kind of difficult when people walk in and they don't have a plan, or we discover that the likelihood of running out of money at 75 or 78 is there, and then we have to sit down and talk to them. We try to extend that as much as we can, but really a good period is 30 years.
Okay.
Yep.
A lot of it has to do with input. I think we've all in business in some sort of way, garbage in, garbage out. If you put in the wrong factors, you're not going to get the right math. But there's so many different factors if you've never planned for a retirement before that you can get wrong. Inflation, taxes, then longevity, and simple things like which accounts do we take from first, which ones do we do tax efficiently. Can you talk to me about how you put together the actual income strategy? How do you do that? How do you help somebody visualize that?
Yeah.
Do you guys use software together that they can share in? How does it look?
Yeah. A lot of people, visual learners. I'm a visual learner, and that's super helpful. So obviously you said inputs are really important. We're going to spend time to get to know exactly what they need, they want, what's realistic, what's not realistic. But once we get all those inputs in, so our software is going to be able to give you a real great visual of your success rate, but also year over year what those projected incomes, expenses are going to be. It's amazing how many times we sit down with somebody and they say, whoa, wait a minute, that's not right. In 3 years, I'm not going to make that, or I'm not going to spend that. And you say, no, actually, that's right on target with historical inflation. And let me show you what it would look like if inflation's 1% more or 1.5% more. So those visuals, they can be a little jarring, but they can also bring a lot of confidence to say, okay, I think I can rely upon this plan. Yeah.
Al, some of those mathematicals, we've talked a lot of times about one of the biggest expenses that comes out of your pocket is taxes in retirement. What about healthcare selections? Are people often surprised with that? Medicare doesn't necessarily cover everything. You've said before, I think sometimes several $100,000 will come out of our pocket on medical costs.
Yes. I think the statistic is people will go through the majority of their money in the last 2 years of their life. The most of their money will be spent in the last 2 years of their life. And so, and then, the pink elephant in the room is long-term care. Everybody's concerned, but nobody wants to talk about it.
Yeah.
And so when we bring it up, we let them know that, hey, there's more than one solution here. There's lots of solutions to be able to address that. And so we talk about that a lot, And I'd just like to follow up on one thing with Joe, and that is that we send them a packet of information when they come in, and we're asking them to bring these documents in. So the information that we end up working with is as accurate as you can get it. And so the more accurate the information, the better the plan is. And so that's, accuracy, giving them several strategies, and being open to their responses to what we're telling them is extremely important.
Right, you are absolutely correct. I'm glad you lightened it up with the pink elephant, but it is a conversation we have to have. I've experienced it myself. 2 grandmothers who went into long-term care, my grandfather as well. I had never heard that, though. Most of the money we spend will be in that last couple of years. But there are ways that we can actually protect it. You said there's solutions. Can you give us just kind of a window into one? I know that not every single one of our viewers can do it, but what do you mean? Do you mean paying for long-term care individually or actually using other tools?
Can I tell a story?
Yeah.
We got about a minute, though.
Okay, a short story. Couple came in, and we've already been working with them, and we'd set up some additional accounts that we're going to use in retirement that we don't necessarily use, early in our lifetime. We've got a particular type of annuity that has an additional benefit rider that adds some long-term care benefits to it. Well, this was strategic. We did this on purpose. And then they come in just a couple of weeks ago and got some bad news. Mr. Smith is got maybe some predisposed tendencies to a certain thing. And the relief that was like, you know what, we've already planned for this.
Man.
We've got you.
Right. And with tools like that, often you need to have something in place before
Exactly.
something happens. Thank you, gentlemen, for all of your perspective today. Folks, we know that retirement planning can be overwhelming. Sometimes we'd rather not think about it, but having a professional who talks about it every single day in their offices can help facilitate those conversations, not just for you, but between you and your spouse and your entire family. Get your own no-cost, comprehensive review. Let's get your strategy put in place. That way we can take care of those unknowns before they happen to you. Call the phone number. Thanks for watching. We'll be back next week.